connection and is able to, please turn on your videos. We have speakers who would like to make it an interactive session, and it'll be great if they can see your faces too.
Or even audio is good, you know.
अच्छा अच्छा, ऑडियो तो चलो एक एक करके ही हो पाएगा अंजलि.
हो पाएगा, हाँ ठीक है.
We have Deepika and
Hello everybody. I'm just figuring out how to use WebEx. So I can't see everybody though.
most people have their cameras turned off, I think.
Oh,
But
okay.
so the live YouTube live has started, Amrita.
Live has started. We can start now.
Okay, great. So welcome, dear friends. I'm so glad to see this seed of an idea take shape. And last Sunday, we had this excellent talk by Devina Mehra, who is a pro of pros, as Anjali says, on finance and investment matters globally. And following up on her messages, and in fact, her article, which triggered the whole idea of having a session on personal finance management for women. We have this session today with two of our own alumni as speakers. We have Anjali Mohan and Manmeet Kaur. Anjali and I were together on campus for some time. She is from the batch of 93, 95. And post IIFM, she joined WWF India. Also worked with Terry for some time. Again, we had an overlap there. And after Terry, she has been consulting in various sectors, from water sector reforms to rural energy and a whole range of other related areas. Anjali also did her postdoctoral research as a fellow with the International Water Management Institute. And for the last 10 plus years, she has been volunteering with this organization called Nai Disha, where, from what I understand, her objective is to get children to enjoy reading books. And she, I think, is spearheading the education wing of Nai Disha. Anjali, you can correct me if I've got that wrong. I'll briefly introduce Manmeet, and then we'll hand it over to Anjali to get the session going. Manmeet is one of our youngest alumni, and she joined IFM in the year 2019, graduated in 2021, and she's working with Sambodhi now. Prior to joining IFM, she did study business economics at Delhi University, wherein they had a wide-ranging, quite a wide-ranging breadth of subjects that were covered, including finance and investment and stock markets, etc. She has a knack, I think, for finance matters, unlike me. And at this very young age, also, she is managing financial matters for a few of her friends and relatives um, on a pro bono basis, I guess. So over to Anjali with that brief introduction. Anjali, please share about yourself, anything else you would like, and then you can get started.
Thanks, Varsha. Well, this session was triggered by Varsha's a very informal conversation with Varsha about helping with financial retirement planning. Or kabhi, I mean, I never thought it would land up like this formal session. I thought it would be more like a chai pe charcha type of thing. But here we are. So anyway, so I've been professionally. I stopped working. I took retirement kind of a thing after consulting for many years. And the last 5 or 6 years, I have been a active stock trader and investing in equities and building up my own retirement fund, which is and where this whole thought came from was that video which was shared on our group on women's involvement in financial decision.
One
Yes,
second.
Varsha?
There's an echo from your end. You might want to mute the speaker on the other device.
It is mute.
Okay. I don't know why.
Is it
there's
still
an
there? Echo?
I can hear it. I don't know about others.
No, it's all
Manvi?
fine. It's all good this side.
Okay.
Should I continue?
Yeah, please go
Okay.
ahead.
Yeah. So what I plan to share today is things that I found useful rather than from the perspective of expertise or training. Lessons that I've learned in my own journey or what I found useful along the way, or you know, when you want to invest and you talk to experienced professionals, they give you such a wide plethora of choices and you really don't know what to do. And so there is a request here.
I don't know. I please ignore that. I don't know.
Okay.
Something is happening
All right.
here. I'm really sorry.
Okay, no problem, Deepika. Again, oh, I'm getting it again. Yeah. Okay. So what I'm going to share with you, and I hope you will also find it useful, it's just a way to uh, decide within various options that are offered by professionals and banks when you want to invest money or buy insurance and other things. In terms of my own, like my work with Night Disha, I can just talk about it a lot and go on about it because it's just so satisfying. But yes, I work with at Night Disha, we work with underprivileged children and women, and I have designed a special education program to help these children who start their education late. So it's a kind of a compressed program so they can be mainstreamed in their age relevant classes. And yes, so let me tell you more about my investment journey, right? So I think my PPT is visible.
Yes,
So the
yes.
basic idea from where this whole need to plan a journey starts is that everybody wants to retire at some point of time, and you want to be able to afford a certain lifestyle that you're used to post retirement also, and not to have to worry about emergencies or other things. So basically it's, and people do want to retire earlier and earlier now. So the ultimate goal behind all of financial planning is taking care of all the finances of all your needs throughout this life. So what I'm going to talk about is how to evaluate risk and return from investment, to understand what are these needs, and especially retirement planning. So
Anjali, you've gotten muted.
Ma'am, we can't really hear you, although you're not muted, but the voice is not at all audible.
I think she can't hear
Anjali, we
us
can't
as
hear
well.
you. Anjali, we can't hear you.
I think she's has a trouble network.
She's on mute. Anjali ma'am, you're on mute.
I'm going to call her.
Ma'am, can you quit and join again, Anjali ma'am?
She can't hear
Oh,
us.
she had gotten muted. She said she's coming back.
Okay.
Anjali, we still can't hear you. Sorry about that glitch. She's going to try again.
Am I audible?
Yes, Anjali, fine. This is good.
All right. So again, should I start with the asset again?
Yes,
Did you
just
hear the cash?
from this slide onwards. Yes, please.
Okay. So all savings account also is considered cash for two, the basic description of cash is that it's very liquid. You don't have to do anything, it's just there to be used. No conversion, no nothing involved. Okay. Then there is in on the other hand, like fixed income, these are these debt mutual funds, government securities like PPF, EPF, bonds, corporate bonds, fixed deposits. Now these are not liquid, but they come with a guaranteed fixed income. They have a certain rate of interest, which like between 5 to 6, um, normally between 5 and 6 percent, and the what there are lots of options. Now the slide moved on its own, but these are the many options are listed in this slide also, with some estimate of the risk involved. uh, Within equity, real estate has three broad categories: the residential, commercial, and land. And in India, one of the most favored ways of investing is through property. And we'll discuss more on this. But as a retail investor, commercial property is really high risk. And residential has many other aspects to it, which we'll discuss a bit later. And gold. Before I move on uh, to the next slide, I just want to gold doesn't mean jewelry. A lot of in India, many people think when they buy jewelry every year, it is an investment, but it is not. It loses gold jewelry. It is not only it loses value, but it is not. When you go to convert it to money or change it, you'll really lose a lot of money. So it's not investment; it is expenses. When they mean gold, it is pure gold or digital gold, like in sovereign gold bonds or gold ETFs. So that is comes under commodity. Now, normally what happens is these different asset classes, they have their own cycles, and if the equity market is going down, then real estate or the fixed income rates might be going up. So they don't move, not all of them will go up and not all of them will go down. So if you want to average your returns over time, that is one of the reasons why it is said that you should balance between different asset classes so that you protect yourself against fluctuations within one asset category. Let me, it will get clearer as we go on, but each of these has two aspects of it. One, what is the return that you get and how much risk it involves, and it's an inverse relationship. So there is no risk to cash, but then the return is also very low. There is no return. Fixed deposits, they have a very predictable rate of return, but there is no um, the risk is not there, but the rate of return is also low. So if you see this, if you see the rate of return here, this is very indicative. These are not the actual rate of returns in a particular year, but equities gives you the highest rate of return. But if you see the volatility, that is also the highest. So this is a trade-off between risk and return that is inbuilt into the various asset classes. Okay, can I move on?
Yes, please.
Okay, so this is again hammering in the point that this is a very simplified presentation of the risk-reward relationship between various asset classes, and the important ones that to note are that government bonds, which are highly safe, they fall somewhere at the lower end of the spectrum, which means your return is also going to be low. The real estate is shown somewhere in the middle, but it can really vary depending on time and the properties of the property itself, the location, the rate at which you have bought it, the purpose, and other factors. So it's now equities is here. It's fairly the emerging market equities. This is developed market equities. The emerging market equities gives a very high rate of return over time. And we will be talking a lot in the mutual funds and direct equity investment both come under this. So the red ones, the private loans, are private loans as in you give it to somebody, you can charge a much higher rate, but then obviously come under a much higher risk. And private equity is like venture capital funds or something which is really high risk. If the new business fails, your entire capital is gone. So between risk and reward, when the professional agents and advisors ask you what is your risk taking ability and how much risk do you want to take, you really don't know what to do. What are they asking you to take a leap of faith? It's like कि नहीं ये safe investment है, इसमें guarantee है, इसमें नहीं है. It becomes very confusing. But if we know how to evaluate, it does not have to be a leap of faith. This is where where historical returns from these asset classes come help. So let's see how money works. Now let me remind you. I'm sure this is a story which everybody is familiar with, but let me just take a few minutes to tell you a story. Now, so there's this little girl, Rani, and she takes care of elephants for a Raja. And she saves them when all the experts are unable to do that. So the king is very happy with her. And he says, whatever you want is yours. Tell me what reward you want. And he spreads this whole box of jewelry, sapphires, all that glittery stuff and says, you take your pick. So the little girl, she thinks of how the elephants are used to get rice away from the farmers who actually cultivate it and how unfair it is. And she looks at the king and then she says, I don't want all this jewelry. I just want a grain of rice to be on the first day to be doubled every day for 30 days. So the king says, what? 1 grain of rice, and you just want, so the next day you just want 2 grains of rice? And she says, yes. So he says, are you sure? She said, yes. And we all know how that ends. By the end of the 1 month, the king is completely flabbergasted when he has to give more than 1 billion grains of rice. 500 million on the last day. He needs 256 elephants carrying bagfuls of rice. All his granaries are empty. And the girl says, okay, I'm going to leave you a little bit of rice for your needs, but in future, please do not be greedy. You please return all the lands to the farmers. So, but in that story, it shows the power of compounding. How 1 grain of rice becomes 500 million grains of rice. So imagine if 1 rupee was to be doubled every day, we would have 500 million rupees by the end of a month. And so now, unfortunately, no one is going to double our money every day, right? But this does show the power of compounding. And it's important to remember this power of compounding because this is how money grows. So at simple interest of say 10%, you can, every year you're getting 10% of the amount. So in 10 years, you'll double your money. But at annual compound interest, you are reinvesting that interest. And if you reinvest that in interest, that means you're compounding it. At the end of 10 years, you've got 59.4% extra over and above what you would have got in simple interest. And this 59.54% is the power of compounding. This is the excess return from compound interest. Now, there are two things which I've put here in this table, is how the rate of interest and the duration of investment impacts this excess return. So first point is that when you invest at a compound rate, you're getting extra money. And the second point is the rate of interest matters and the duration. Now these tables are more difficult to absorb, so I've put that in a chart, okay? Now look at this chart. Now the same amount of money invested for 5 years, 10 years and 20 years, and you'll see how much difference there is in just the time. And the other thing to note is that ये जो blue वाली line है, that's the 5% line. But if you're investing at 10%, look at where the orange line is going. That is the difference that a rate of interest causes to your, if you are investing at even a slightly higher rate of interest, compounded makes a lot of difference, right? So, you know, this yellow line, this orange line is very inspiring. If money can grow like this, it looks very nice, doesn't it? So money may not grow on trees, but money does make money. Is it okay? Should I move on to the power of compounding is fine? So a simple rule to tell you how it works or how to calculate this on a very rough basis, an approximate basis, is the rule of 72. What the rule of 72 is that if you divide 72 by the interest rate that you are being offered, it will tell you the number of years that will take for your money to double. Or reverse, if you are investing money for say 5 years and you divide 5 by 72, it will tell you the interest rate that you are getting. Use it on inflation. Now, if we are sitting with a 7% rate of inflation, it means that in 10 years, 72 divided by 7, approximately 10 years, your investment or your savings will have lost half its value. Now, if the inflation rate is 10%, then in 7 years, your money will be half its value. So unless we invest at a rate which beats inflation, you are actually losing value at a compound interest rate. And the other point here is that sometimes not sometimes, for each individual, the rate of inflation may be higher or lower than what the government figures say. So if that depends on, maybe you travel how within that inflation category, the rate of inflation for transport may be higher, or power may be higher, or vegetables may be higher, and it depends on your consumption basket to know what kind of rate of inflation are you facing. Maybe health costs are going up more compared to say other services. So depending on where you are, your rate of inflation which you need to factor in may vary from 7 to 10%, anywhere between that. So this is a kind of benchmark if we need our money to grow. So before we go to the actual investment, there's a slight detour because Varsha, you wanted some people wanted the tax to be brought in between the old and the new regimes. In a nutshell, now tax varies a lot from person to person, but in a nutshell, the new revised regime kind of saves money for almost everybody. It's a better way to go, unless now here I've put in a nutshell. Again, it's a nutshell because this is a very salary and salary structure dependent analysis. So there are, in the old regime, you had deductions and exemptions. Deductions like how much investment have you made in all of these things. So PPF, ELS, the equity linked saving schemes, EPF, all of these home loans. So all of these had certain, up to a certain amount you can deduct from your taxable income. And these exemptions were not taxable. Whereas in the new regime, everything is taxable. Even PPF is not exempt. Except for the pension, national pension scheme, everything else is taxable. So in a nutshell, ballpark figure is, for an income of more than 10 lakh, if your savings and these exemptions are more than 3.5 lakh, then the old regime may still make sense. Otherwise, the new regime is better. For an income of 8 to 10 lakhs, the old regime may be better for an investment of 2.5 also. But this needs to be calculated on a case-to-case basis. But if your investment is anywhere less than 2.5, then definitely the new regime is it is better. I won't say hugely better, but yes, you will have to pay less tax if you follow the new regime. So now, coming back to making money work for us, okay? So it's all about income and expenditure. Basically, these are the two main flows that one has to decide. If everything that you earn, you spend, then you don't create this stock. Now, this stock of money that you have, the difference between your income and the expenditure, is what you can use to multiply money, to invest, and for this to become wealth. But if income and these flows are not controlled, then this stock doesn't happen. And without this stock, you really don't have that money to invest. So the first step to financial management is to create the stock by managing the flows, which is the income and your needs. So let's look at needs. And I'm going to use Maslow's hierarchy, which everyone is familiar with, to see what needs at what stage. Now, the basic human needs, psychological needs, physiological needs, roti, kapda, makan. Now, this will happen, this you have to face for the whole life. So, and this kind of becomes very important to even assess how much you need to save for retirement. So this component of the financial need, gives you your monthly expenditure, which is absolutely basic. You cannot reduce it to a large extent. It involves expenditure on food, either house rentals or EMIs or house maintenance, and to a certain extent, clothing, some bit discretionary and some bit necessity. And especially for the younger generation, the people who are just starting on their investment journey or becoming independent earners away from their parents, it's very important first to create an FD which will cover at least 12 months of this basic per month kharcha. And here I'm going to tell you something about FD which I found very useful. Now, this FD comes at a lower rate of interest and it doesn't look very attractive. But if you create this FD in a Sarkari bank, you can get 90% of this FD amount as a loan. And on this loan, you pay only 0.5% rate of interest extra over and above what your FD is earning. So it actually gives you the cheapest loan that is possible. So supposing you need, there is a sudden, you need a sudden amount, small amount of money, and you have an FD. Instead of breaking that FD, you can take a loan against that and repay it as and when you can. So I keep this FD it's called an overdraft account. I keep an overdraft account because I do equity trading, and this gives me the liquidity that I might need. So
Anjali, check if you've gotten muted.
Yeah, so it's now here when we are investing to create security, the idea is not to maximize return from this. It is to make sure that what you are creating it for is covered. So this FD is to provide security towards this, to meet this basic expenditure in a case of emergency. The next important thing here is shelter house and the decision whether to buy or rent a house. A few years ago, the first thing which we would hear from our parents was, as soon as you started earning, take a house loan and invest in a house. Now that decision needs to be revised in terms of where the house prices are, whether this makes sense or not. And if you look at it from a pure financial perspective, investing in a house may not make sense. Living in a rented house may make more economic sense. However, buying a house has a lot more connotations to it than just a financial implication. You know, there is a certain emotional security that is attached to it. It's in the longer run, it becomes a stock where, let's say, for retirement, if you need I'll come back to this point when we talk of retirement. So, and also for a girl, especially for a girl also, you know, you have that comfort that this place belongs to me. There is safety and there is security attached to it. You know, you have harmony living in your own house. So there's definitely a lot more than just a financial decision to this. But in today's time, when you buy a house, it should be the decision can be taken as per your financial status at that time. Say, for example, you have an option of buying today and taking a house loan and or buying after 10 years. So if you buy today, you don't know, you have to estimate whether you have to sort of think that is this going to increase at a rate of more than a rate of inflation, or are the prices too high? If the prices are too high, it's okay to wait and then build your capital for a while and then take a house loan after 10 years when you have your own capital also. How that works, we'll see when I have a example for retirement fund. The same logic would apply to a house buying fund also. So we'll come back to this, like this calculation per se. In terms of safety, you need life insurance and you need health insurance. You need PPF and pension plans or pension plans. So PPF is this is one of the best government options, government security options that are available to us. It at today these days the rates are 7.1%, and it has a lock-in for 15 years. But it gives it is a tax-free exempt status, which means the money you invest in it is tax-free if you're opting for the old regime. The interest you earn on it is also tax-free, and what you remove from it when you take it out is also tax-free. But all other pension plans, everything else is taxable. So it also, PPF has a clause wherein you can take money, you can take a loan against it up to 50% of the balance 4 years ago. So all of those clauses are there, and over time it builds up. It is a it adds, and this is for if there's a big disaster, you have to reconstruct your house or do something like that, or children's marriage, PPF can be very useful. So it's one of those. This really fits Maslow's second stage of providing safety. Now, when we talk about insurance for this purpose, for life or health or assets, it's important to remember that this is not for investment. No insurance instrument is going to give you the same kind of return that a pure investment option is going to give. So insurance is meant for a certain purpose, and that is to provide protection. Say if you're buying a life jacket, you don't want to know what else the life jacket can be used for. You want that life jacket to work to provide you the best protection in case you're drowning. So you're not going to ask, can I wear that life jacket outside or do something else with it? So when you're buying insurance, make sure that it provides you first and foremost the best cover that you are wanting. So whether it's health or life, it doesn't matter what the endowment is going to be or what. Buy insurance that meets the purpose. That way, Policy Bazaar gives a very good platform to compare between all the things and take an informed decision. And no insurance product is going to give you a good investment option. So I think there's a lot of confusion, equity linked pension plans, but they may be low risk. And we will compare one of pension plans to a higher risk option. But in terms of returns, investment should be kept away from safety needs. So, but after having provided these two levels of Maslow's hierarchy, providing four, then what you have left can go as discretionary expenditure, or you can invest it to create that stock which can multiply and give you wealth over time. So bigger and when you reach family and friendship stage, you start paying children's education and travel and foreign visits and everything, and then by the time you are in middle age, you're at a senior position, so you need a bigger house and you have status and everything. But all of this is all right. Finally this is where all our vasanas have to get fulfilled, and one must plan for it, and it's fine. So towards self-actualization. Now, actually, this is that Adi Lakshmi. Now, in India, actually, it's a very interesting thing. Lakshmi, as you know, has 8 manifestations. And if I may digress a little bit here, let me tell you about the 8 Lakshmis, just to so many of us may know it already, but so there's Adi Lakshmi, which is the self-actualization kind of a concept. Moksha Pradayini, she's that part of the energy that is it is the curiosity to know, to have a much larger perspective on life. Where have we come from? What is the purpose of life? And those kind of, that spiritual journey. Then there is the Lakshmi that we all know, the Dhanya Lakshmi, material wealth. There is Dhanya Lakshmi, agricultural wealth, nutrition, food, Dhanya Lakshmi. So then there is Gaja Lakshmi, the strength, elephant strength, royal valor. Then there is Santan Lakshmi, blessings of Lakshmi to give you progeny, fertility. Then there is Virya Lakshmi, Dhairya or Virya Lakshmi, which is courage, and strength, bravery. So there are people who will be always scared to take action, afraid to take risk. That's a kind of abhav of Virya Lakshmi. Then there's Vidya Lakshmi. Knowledge comes only with Lakshmi. And Vijay Lakshmi. You've seen there are a lot of people who really struggle, put in a lot of effort, but success seems to elude them. And that is a bhav of Vijay Lakshmi. So if you see Lakshmi, if you talk about Lakshmi, it is so Saraswati is not wisdom. Creativity and wisdom is Saraswati. These are all and Vidya Lakshmi is more, the knowledge and education. So all of this hierarchy. So, uh, in term, the Lakshmi energy is, she is the consort of Vishnu. Vishnu is the sustainer of the world. So all maintenance comes from Vishnu and Lakshmi. Lakshmi is needed to maintain everything. And Saraswati is the creative energy, the thought energy, the ideation. That energy is, and Durga is the change, the destruction leading to change is Durga energy. So Lakshmi, the Ashtalakshmi that we all worship is actually covers all of Maslow's hierarchy. I think it's all, yeah. So we have so it's important to have a larger perspective on money. What is going to be enough? What is till when do we have to strive to get more money? And that happens, this larger perspective, this sufficiency, this sense of abundance comes when we know we've got enough to live the rest of our lives happily, or we have enough that you feel that acha theek hai, now we have that security. Even if you don't earn more, you are taken care of and you have enough left over for children and charity and other stuff. So how do we calculate how much is enough? Okay, so I come to when do we know that enough, we have enough? So as a very back of the envelope calculation, what I thought was, let's take, say you have some rental income or some 50,000 a month, including some rental income, which comes to 6 lakhs a year. And if I take a life expectancy of say 90 years, one would need a corpus of 1.8 CR, which has to be invested at a inflation rate. Otherwise, your savings will half in 7 years or 10 years, and then further half in somewhere, and you'll be left with a 1/4 tank of water. Even not even that, because at that during in that 10-20 years, you will still be spending 50,000 a month. So how does one reach here? How to create this first, and then how to maintain it also. First thing to do is to see how much you need, this 50,000 a month in. And if you have a house, then you basically have another tank here, which is a stock amount. And if needed, one can sell that and then live on rent and have, use that for the rest of your life. So once you have an estimate, then I compared pension plans versus mutual funds, and how much would one need to say have an income of 25,000 a month, assuming you have a house already. So, and maybe investing, say, only 10 years, at the age of 50, you suddenly realize I have to retire soon. So let me invest something. So at the age of 50 years, if I have to invest, so I invest 25 lakhs in a pension plan or in a mutual fund. And most mutual funds are giving more than 10% return, but that is in today's right now's climate. And it's not necessary that they always give it, but over time, the return is likely to be more than 10% if you've chosen the good fund. So pension plans, I compared some. So if you invest 25 lakhs, you get 25,000 a month, approximately. Most plans are around that range per month, a fixed amount, guaranteed amount for the rest of your life till you die. And once you die, then they give 25 lakhs back to your nominee. Sounds like a great deal. If you invest 50 lakhs here, you get a pension of 50,000 a month, approximately. And if you invest 10 lakhs, they're giving you 10 lakhs. So it's a sort of the same. So is this a good deal? And it definitely is a very safe deal because this is a guaranteed set of returns. Let's compare what happens when you invest in a higher risk mutual fund, which says that it might give you 10% of return or higher. Investing the same 25 lakhs for annual compounding for 10 years gives me a maturity amount of almost 65 lakhs. But this is not going to give, they are not going to manage my withdrawals, and there is no guaranteed return. Okay. So, but how does 64 lakh compare? If then I converted it. Okay. I said maybe at the age of 60, I don't want to take that kind of risk further. So let me take the 64 lakhs out and invest it in an annuity plan, which is the same, very safe investment, like a safe pension plan. So I looked at HDFC's annuity plan, and if the purchase amount is 60 lakhs, I get an annuity of 34,000 a month. And I get the return of the purchase price, which is now 60 lakhs to my nominee once I die. Sounds like a better deal, a much better deal. But this, as I said, comes with a higher rate, higher risk. What is this risk? So all of this equity linked investment options are based on the performance of the stock market. And in a longer term, the stock market does give return. But at the time when if you want to withdraw money, it may or may not be a good time as far as the stock value is concerned. And that is the risk. So the risk is not in absolute terms whether you'll lose your money, but it is in terms of the time period. There may be periods for even 3-4 years, the stock market may not give very good returns, but over a longer time period, the average returns will definitely be higher than any other guaranteed return investment plan. And this difference that you see here between these two is something that you are going to be paying as a management fee to whichever company you take your products from. So it's a good thing to think. And it doesn't have to be one extreme or the other. It doesn't have to be entirely pension fund or an annuity plan. It can be a mix of both. Uh, and to the extent that you want to invest your time in understanding pension mutual funds, what they are doing, whether it's large cap, small cap, what should I do, it needs a certain amount of management to guarantee a better return. Whereas with a fixed pension plan, you don't have to worry. You've given them the money, and you're going to get your monthly income, right? So but you can see the difference that is there, and it is a substantial difference. Now the same logic works when you are planning for buying a house. And a house loan, when you take a house loan, this same power of compounding actually works against you. So you are paying the bank a compounded rate of return. And I don't remember the exact figure now, but a few years ago with my son, we did a math project in school wherein we had to find out the actual rate of loan interest, the actual rate of interest that you were paying on a loan. And from there, when I looked at house loans or any other loan, it actually came to a lot higher than what is advertised, the actual amount that you return. So any loan that you take, the faster you return it, you're making money, you're saving money. Any loan. The cheapest loan is what I told you, the FD against the FD, where you're paying 0.5% extra, and in a private bank that is also 1.5% extra compared to, and 0.5 is for a Sarkari bank. So let me just so in a nutshell, this return is what one has to understand on compounded rate of return and how to generate that. So I will sum up very quickly. First is to save some money. And how do you save it? As a standard rule, your needs should not exceed 50% of your income. And if they are exceeding, then you need to reevaluate your needs also. And at least 20% savings, if you can reduce your wants and do a bit more at a certain time when you need to invest, that is also a good thing. If you start early, you get more compounding of your money. So if you, for freshers, if you save even say 18 to 20,000 a month, you actually higher return. So the caveat here is that risk with equities is real, but the return is also real. And say when I do direct equity trading, the strategy I'm also using is compounding. I instead of trying to maximize returns, I am using this power of compounding. Say if I decide I'm going to rotate my money at 10%. So I'm not going to wait for a trade to give me a very much higher rate of return. Even if I'm getting 10%, I can take it and rotate it to something else. So I'm basically, what I'm doing is a faster compounding. But in a short term, if I have to withdraw money from there, then it is a higher risk. So the risk again with mutual funds and with this is a time period risk, as I see it, not absolute. There are certain absolute risks, like you might invest in a company which is a turnaround story, but it turns around and falls into a ditch, in which case you lose all your income, you lose your capital. Even with debt, corporate debt, so corporate bonds give you a much higher fixed interest than government bonds or other fixed income instruments, which Manmeet is going to talk about later. But in the corporate bonds, there is a higher risk too. Say, for example, DHFL a few years ago went bust. So equity was immediately written off. Equity, any company which is going bust, the first thing that will happen is the equity will get written off, which means you lose all your capital, and whatever you have invested is now turned to zero. But the debt also suffered a loss, but you got say 25-30% was returned to on the debt. So some of the corporate bonds, when you're purchasing at say higher rate of interest, which give you 10-11 per rate of interest, do carry a risk. And one has to evaluate and monitor what is happening there. So anything that comes at a higher rate of interest will come with some risk, with a higher risk. So well, I'll before I open for questions, just so the simple rule is that at the first 2 or 3 levels of Maslow's hierarchy, you have to sacrifice returns and avoid risk. The purpose of investment there, the purpose of putting money aside is to avoid risk. It is not to maximize returns. It is only once your safety is ensured, then you can invest money to maximize gains. And that is where money starts making money. So invest in your security first and then take risk. Okay, so thank you. Any questions? I'm happy to, if I've missed out anything.
Thank you, Anjali. That was a whole lot of difficult issues that you dealt with, but you managed to explain them in such simple, easy to understand laywoman terms. I'm really, really thankful that you did that. I see some questions beginning to pop up on the chat screen. Um, uh, or was it a raised hand? No, Deepika has a question here. Deepika, would you like to go ahead and ask?
Yes. Thank you, first of all, for this very informative session. Um, I was curious to know about government bonds because I remember in the last session, I think Devina ma'am also mentioned that government treasuries are one of the good investment, portals to invest in. So I was just wondering whether government bonds in comparison to corporate bonds are less risky, or what is the scene like in that, because I've no idea. It's just that I'm just exploring these avenues, and I just wanted to know a little more about it, if you can help us now.
So
Thank
government
you.
bonds are risk free, and they are a good option, but they give you enough to manage inflation. And corporate bonds, as I said, they will give you higher rate of interest, but it depends on which company are you taking it from, and they all have lock-ins also. So depending on the instruments, and you can Manmeet can cover it more in her. She can maybe not today, but in a subsequent session, maybe she can cover the various options that are available.
Anjali, you had
So
that
these
slide with
bonds come in with a lock-in. Sorry?
Anjali, you had that slide with the different kinds
Yeah,
of options. I think
yeah,
that also listed the yes. The
yes.
next
So
no
government bonds,
next
senior
next
citizen,
next
this one,
no after this yes here
this one.
no
Yeah,
no yeah
yeah. So government bonds are lower risk, lower return. Corporate bonds are slightly higher risk, higher return. But this all falls into your safety net. So you don't have to put in, see, depending on your age, you don't have to put in all your money. This all of this falls in this level of investment, in the first the safety
it's
net.
two levels
Yeah.
right.
Okay, thank you.
Thanks. Do we have any more questions or comments?
It's a very heavy topic, actually. It takes time to think about.
Yes, I don't think I've ever gone through such a crash course on personal finance before.
Okay, I
So
see
what's
two
a
relevant questions in the chat box. One is by Diksha. She's asking if PPF on maturity is taxable under the new tax regime.
no, it is not taxable.
It's not. It's still under the exempt category, Diksha.
Yes.
Yes. And there's another one by Diksha. For those who have NPS, what percent of allocation do you suggest?
What percentage of for
What percentage of
NPS?
allocation of total investment do you suggest to do in NPS?
See, NPS is not investment. It is an insurance. It is a pension plan. It is again in this category, you know. So this safety category. But NPS is you can it is also tax exempt. So maybe tax limit तक कर लो. जितना tax benefit होता है उतना you can do. See, anything you have to. One is that the criteria that one can use is whether you can or not. How much is your risk appetite, and are you in a position to invest it at a higher rate of interest? If you feel no, मेरा अभी risk appetite नहीं है, I want a safe investment, then go ahead with this.
पर आप जो बोल रहे थे अंजलि, your risk appetite will depend on whether your essential needs are taken care of or not, right? So if you have invested enough for your basic needs post retirement, let's say, and taken care of insurance and whatever else is necessary, then your
Yeah,
risk appetite is likely to go up, and
yeah,
you will potentially get higher returns as well.
right.
Okay.
Absolutely. So supposing I am like, I have set aside, say, 6 or 8, 10 lakhs in an FD, which takes care of any emergencies for a year. If I get laid off, I have to survive. I put in that amount. I put in my 1.5 lakhs in PPF. PPF ka limit for per year is 1.5. You cannot invest more than that in that. You put in for PPF. PPF is a good security net. If you have girls, you put it in that Sukanya system, Sukanya, uh, and all those good, the 2 or 3 good schemes of the government, which give you a higher rate of interest, and they are very safe long-term investments. Plus, they build capital for the children. Once you've done that, you buy insurance. Insurance, again, it's part of that basic portfolio that everybody should have. You buy term insurance, which basically provides for your survivors if something happens to you.
Right.
Only term insurance. You provide for health insurance based on whether you have dependent parents or children and yourself. And if you have a car, you need car insurance. All of those are mandatory insurances. If you Once you've provided for insurance, you've provided for PPF. Pension plan is your wish. You have a long runway to think on how to design a pension fund. And you don't need to go into a very safe investment at a very young age. Maybe you can use a mutual fund to generate higher rate of, or maybe both, a little bit, have some kind of allocation which you are comfortable with. You decide, okay, I'm going to invest so much in a pension plan and so much in a mutual fund, and over time I know that the fund will give me a good return. If it is not giving me a good return, you change your fund. You go to a growth fund or a balanced fund or flexi fund. It
I
might give a better return.
Yeah, I think Anjali, people still need to learn about these things, if I'm not
Yeah,
mistaken.
so basically, here the thing is, the basic message that you have to take is that if you invest in an equity linked, in equities, either directly or through mutual funds, you get a higher rate of interest. And Manmeet will talk about the various mutual funds that are there and how to evaluate those.
Yes, I think we have a question here. Amrita is asking. Amrita, do you want to go ahead and ask your question? Or should I read it out?
Yeah, I wanted to know, ma'am, if where should I go and learn about investing and like trading or like maybe stocks if I'm totally new to this and I just started earning. Someone who's in
Google.
20s.
There's loads of stuff on Google.
But isn't
Just
Yeah,
Manmeet taking our next the next session is on this, right?
yeah, I guess she's
Well,
taking.
I would try my best to address Amrita's concerns in my
Yeah.
session. Yeah.
Okay, someone called Zomato. Who is this? Will you please identify yourself? As Fed interest rates are getting high and recession is knocking on the doors, how do you see investment in the bond market and gold? Can we also look for investment opportunities in cryptocurrency? This is from a guy, I believe. I doubt if Zomato is a woman.
Okay, but
Do you want to
crypto
answer that?
is I have absolutely no experience in crypto, and if you can make money and get out, you want to. It's a gamble. So I mean, you can see the thing is that with any of these things, whether it is gold or equities or derivatives or cryptos, you can make money as long as you know what you've studied that asset class.
Hmm.
Uh, if you go as a without knowing enough, then you're going to lose money. So
Right.
everyone else will make money on crypto, and you might still lose money. And in you know,
Yeah,
if,
yeah, that's
even
good.
in the stock market, you need to put in that effort to know what you are doing, to have that confidence to do it, and then take an informed decision. There is no rule that everyone's going to make money in the stock market, or everybody is going to make money on derivatives. So if you put in that effort, you're going to make money.
We
It's a
have a
skill
very
that you
good
need to
question.
invest in.
Yeah, Anjali, we have a very
I would
good
like
question
to
here
add
from
some.
Bharti.
Sorry, go ahead,
Somebody,
Varsha.
somebody wanted to add something, please.
Yeah, so I was
Can I
saying
just
that
finish?
yes, yes, please
Can I
do.
just? So his other point was gold and bonds. Now gold has already run up. So investing, because of a recession, forecasted recession is, and gold is not a very liquid asset. So it's, you have to take a decision based on your needs and liquidity, and then take a call on it. I not on the current market conditions, I would say. If you think that fundamentally this is a good thing and I'm willing to hold it for the next 10-20 years, and I'm going to make money on it, then it makes sense. Otherwise, I think it's better you go with other options. Yeah,
Right,
sorry.
and drawing further on that liquidity point, I would like to add another 2 cents that it's
Huh.
good to invest in bond markets in bonds and golds when you want to avoid the volatility in the market. So if you think that the market right now is not very volatile, you can skip investing in bonds and gold at the moment. Or it also comes at the expense of the liquidity angle that Anjali ma'am just mentioned. Apart from that, bonds and golds are uh, they're difficult to trade in the secondary market as well, be it in any form. I'm talking about gold here. And then like you said, can we also look for investment opportunities in the cryptocurrency? You can, if you can time the dollar, because crypto is said to follow an opposite trend to the dollar. If you think that the dollar is strengthening, then you would know that the crypto results are falling. So if you think that increased Fed rates are a signal of a weakening dollar, then go ahead, my friend. Crypto is the way.
Good. I think that's some great advice. Bharti, do you want to ask your question? Bharti, are you there? Okay, Bharti is saying like the rule of seven.
Yes, I have
Yes, yes, yes.
some
Please come.
problem with the audio. Yeah.
Okay. I think she said her audio is problematic. I'm going to read out her question. She says, like the rule of 72, is there a simple formula for making a rent or buy decision on property?
Um, if you, there is no formula, but if I was to help you with that a little bit, if you are going to live in that immediately and you don't have to pay the EMI and a rental separately, it may make sense. But if you are going to pay rent and do an EMI also, then it may not be a very good idea.
Okay. Yeah, makes sense. That does
Also,
make
you
sense.
can compare that if you take a loan right now, how much how much EMI are you paying? If you take a very back of the envelope calculation, reverse it and say, if I put in this amount in a mutual fund or in two or three different investments, how much will I make in that same time period? So you can still buy a house after that. If your investment today is growing at a much higher rate and you think that the property prices are not, they don't have much room to grow further, then you can buy it after, say, um, uh, uh, say 5 or 10 years, if you're
Right,
not going to live in it right now.
right. Um,
Does that answer your question? Say, Bharti, let me give you
yes.
an
She
example.
says yes.
Say, Okay, okay. I can let me give her an example.
We have some comments from Kolol which you can read in the chat box. In the meantime, I would like to offer the floor to Manmeet. The idea is to check from the participants what is the kind of information that we should be covering in Manmeet's session, where she talks about the different investment avenues and the criteria for decision making. Manmeet?
Yes. So, if everyone is okay to go ahead with the next session immediately, we can start, or else we can take a quick break and resume in another 5 minutes. So, the sentiment is of the audience here.
Or next week?
Yeah.
No, we're already at 4:15. We're past 4:15. So, what do you say? Audience, do you want another session next week? Or maybe sometime during the week, depending on Manmeet's availability as well?
We can please.
It is already a lot of info to process. That's right, Deepika. I completely agree with you.
Yeah, and I think you'll be able to handle the choice which the Manmeet is going to offer you a lot better if you apply the if you actually do some of these calculations and see what works for you.
Right.
Okay, I've just launched a poll. If you want to have this session today in another 5 minutes or next week, I think the poll is open and it's waiting for your votes. So everyone, please cast your vote.
Oh, it's on the group, is it?
It's there here. I mean, in the WebEx thing itself.
Oh, all right. Okay. All right. Now it's showing. Hmm. Okay, we have 5 people who have voted for next week, I think.
I should also tell you the offering. The offering is I won't take 2 hours. It'll be a quick one for sure. I'll just take the participants through tips and tricks to shortlist some good funds, shortlist some good insurance plans, what to go ahead with, what not to go ahead with, how to decide amongst various options, so on and so forth.
Manmeet, I'm sorry to disappoint you. 62% so far have voted for next week.
Yeah. Okay, that's cool.
But only 14 people have voted so far.
And how many people are we?
We are 23 participants as of now. That should include the 2 of you.
So should we close
I
the
think we
first?
should we can
Go ahead, Anjali. You were saying something?
I think it is what Manmeet is going to offer. It needs a lot of concentration to grasp all the differences as well. So maybe Manmeet, if you do a quick, do you have something which you can just sort of what is on offer, or you take a call on what you think you would want, you know? Because you are going
Nay,
to
I
put
think
in a
if majority
sorry.
of the audience is in for the next week, then let's hold it next week because I don't want
Okay.
uh,
Yeah.
overflow and overwhelming.
Right.
Yeah,
Right.
yeah.
Right.
Manmeet, how long will your session be if you do it today?
40 minutes at max.
Okay. Okay. That is longish, I think. Let's have it next week, Manmeet.
Sure, that works.
I hope friends who have voted for today will still be available next week. All right.